Good morning, everyone. Welcome to the quarterly update for Growth Fund 4. My name is David Scherer. I'm co-founder and co-CEO of Origin Investments. You know, my partner and I founded Origin to protect and grow our own capital. We've seen a lot of market environments since 2007. This environment's no different. It presents both challenges and opportunities. At Origin, we have a proven record of attaining our investment goals. Fund 4 will be no different. We've also proven that we've beaten 95% of other real estate managers in net returns to our investment partners. Fund 4 will be no different. I'm joined today by my partner and co-founder and co-CEO, Michael Episcope. I've had the pleasure of working with him and being his friend for probably 20 years at this point. And we've received over 50 questions, and they have a consistent theme. How are the fund investments performing, the ones that we've made? In this current inflationary environment with higher interest rates, higher construction costs, and will we be able to continue to find development deals that meet the investment goals of 14 to 18% net returns? Michael are going to address these questions head on, and we're going to actually also address a few more. One of which is the disconnect between public and private real estate valuations. My partner Michael is going to be diving into that. We're going to handle internal valuation policy procedures and due diligence. It's really important because our valuation policies extend to due diligence. So if we actually are starting on a deal, it means that even in these different market conditions, it meets our cost of capital. And he'll give you some examples of that as well. We're going to talk about our interest rate hedging for Fund 4, which has been quite extensive. And then we're going to dive into the supply-demand imbalance of housing. We have a lot to cover. I'd like to leave 30 minutes for Q&A. I know that people want to ask us direct questions, and we value the direct conversation. So let's get started. First slide, please. Really enjoy this picture. That's our head of our Denver office, Tom Briney, and our head of accounting, who's been with us since 2009, Priya. At one of our buildings, this is the QOZ site in Colorado Springs about a month ago. Let's talk about interest rates a little bit. I think everyone on the call knows that interest rates are up significantly. The risk-free rate has gone from roughly 1.7%. And when I say risk-free rate, I mean the 10-year note yield. It started in January at 1.7. This morning, it's 4.13. That's an analogy of, you can make an analogy that that's the stock market going down from, it's an 80% move, or it's more. I think it's a massive move. Let's just say it's 3 standard deviation move. Luckily, we got ahead of that. I don't think that's by accident. Credit committee has been meeting throughout, and we identified that as a risk we needed to hedge. We did. Mike will go into how much that's generated for this fund, but it's significant. And that's what you pay a manager to do. You don't pay us to point out the obvious. Interest rates are higher. You pay us to see a risk that we can't control and mitigate it, and we did. And this fund is benefiting greatly for that. In terms of where rates are now, it's my belief personally, and Michael I think agrees, at a 4.13 10-year, it's probable that we're in a new range, that we'll reach equilibrium somewhere between 3.5 to 4.5. The yield curve is inverted, which implies a recession is coming, and we'll touch on that. It's been a very predictive element if you see an inverted yield curve. And what I mean by that is the 2-year note yield is significantly higher than the 5. The 5 is significantly higher than the 10. This morning, the 2s are about 4.7, the 5s are about 4.5, and the 10s, as I said, are about 4.13. So that's pretty predictive of a recession. What that means is it's unlikely in a recession that long-term rates continue to go up. But nonetheless, we're hedged, and that's a big point here is I can have an opinion, but I also am never sure, right? So the world's a probability. I feel it's more likely that we're in a range and it's been established. But if rates went to 7, I still want to be able to make money. And so that's why we hedge interest rates, even though it might be that we've sort of reached peak here. Construction costs have been part of this inflation story in 2021. Typically, they go up around 3%. Last year, it was more like 12%. And it was caused primarily by input costs, but increasingly also by labor. Those have turned around. So in other words, construction costs have ceased rising about a quarter ago. And now we're starting to see the first green shoots of construction costs actually going down. And we're seeing that because we're so active in the market. And we'll touch on that because that's a big part of when we reevaluate deals. That's why it's a moving, each business plan is a living, breathing model that you have to evaluate consistently. We have seen that construction costs are coming down. We first saw it in lumber. The board foot sort of peaked at 1,500 a board foot. Now it's about 450 a board foot. So again, massive moves. And now we're starting to see it in other input costs. And I'll touch on why in a bit, but the cliff notes is home builders are building a lot less homes, and that's producing way less demand for both goods and labor and construction. And so that's starting to work its way through the market in a positive way. Capitalization rates, which you can view either as the unlevered return on equity relative to basis, or importantly, the multiple that you receive on earnings. Capitalization rates have gone up considerably this year, which isn't a surprise with interest rates going up. They tend to follow each other because interest rates are a very important input into the weighted average cost of capital on a deal. So when we started the year, capitalization rates were plus or minus 3.5 in our markets, which, as you know, are Texas, the Southwest, and Southeast. Today, they're more like 4.1, 4.2. So that's on a percentage basis a large move. You're talking about a 15% move. And what it really means is the multiple on earnings has gone down from around a 28 to around a 23. In terms of asset valuations, it hasn't been as drastic because rents have gone up considerably this year as well. So you're getting a lower multiple on a higher EBITDA or a higher net operating income. But nonetheless, asset values are down, probably in the neighborhood of 5 to 10% at the asset level. And that's sort of a broad statement based on a lot of information that we have, both in the private markets, public markets, refinancing markets, et cetera. I view this as a net positive. We needed our multiples to come down. They were irrationally high in 2021, largely caused by 0% interest rates that were there for too long. And then lastly, and importantly, Origin never underwrote a 3.5 cap in any deal, not just in this fund, but this fund, QZ. We didn't believe it was realistic. So we really were starting our cap rates where they are today, even when it was a bit irrational last year. So although cap rates are higher, it's not affecting our valuations at this point because we never underwrote deals anywhere near those levels in this fund. And then the last is available liquidity. There's a record amount of capital that's been raised for private real estate, and multifamily real estate is certainly a favorite in the real estate world, and it should be. It's an essential asset. It's almost impossible to disrupt via technology. You need a place to live. And the valuations have been incredibly both good in terms of returns and stable in terms of multi doesn't really correct much because it's an essential asset in the way that a discretionary asset would, like a retail asset or an office asset or a hotel asset. So we're the fundamentals are very bullish in terms of, on the private side, it's difficult to believe that valuations can go very much lower given the amount of capital that's looking to invest in private real estate. And in multi in particular, I'll hit the fundamentals. They're very, very strong. Next slide, please. The home affordability index is it's not surprising when you look at this that again, this index, it's basically telling you that homes are at a record unaffordable level right now. And that's sort of pointing out the obvious. So if you're in our markets, if you're in Florida, if you're in Austin, if you're in Nashville, if you're in Denver, homes have gone up in value 15 to 20% a year for 2 years in a row. And obviously that makes homes less affordable. But then what happened was the borrowing rate went from 3 to 3.25 on the 30-year mortgage to 7.5. And so what you're left with now is these homes they're not affordable to a large swath of the population. That population then becomes renters for much, much longer. It really helps our demand segment. And we've already seen that. I mean, that's why rents, one of the reasons rents have gone up so much this year is you have trapped buyers, people that want to buy homes and can't. This is going to affect demand in a positive way for us for quite a while. This won't work its way through for quite a while. And then the last thing I would say is one of the areas we really like is build for rent. And a lot of the deals in this fund and the deals that we're underwriting for, in the pipeline are build for rent. And the reason for that is it gives you the feel of home ownership that you're still a renter. And the margins are quite high. It's a little bit cheaper to build horizontal product than vertical product, but you're getting similar rents because people have attached garages and yards, and it feels like a home, even though it's a rental. Next slide, please. When I spoke about construction costs coming down, you'll see this graph is important in looking at that. Home building as a percentage of population, it really it tanked in 2008, 9, and 10, and that shouldn't be a surprise. That was the Great Recession. That's when the imbalance of homes that we need in the U.S. versus what we have started. It started to correct a bit from 14 to 20, but now it's plummeting again. You can see it in the home builder stocks. They're down significantly this year. They don't want to build a lot of new homes because, back to the previous slide, the home affordability is so low. So they don't want to build homes that people then can't buy at the basis they need to make money. So that's pretty logical. So what's going to happen going forward is the long-term fundamentals for rentals are very, very strong because we're underhoused. And what's going to happen in the next 2 years is that's going to be exacerbated by even less homes that are produced and started in 23, 24. So we really like the long-term fundamentals of multifamily real estate. Next slide, please. Michael and I have the luxury of, we talk to investors quite a bit. We have, I believe it's 3,200 investors, and many of them email us directly, and they'd like to talk about a particular fund or a particular article that they've read. We obviously can't talk to everyone, but we talk to a lot. Like, for example, last week, I believe I spoke to 4 investors, 15, 20-minute calls. And one of the things that kept coming up was an article in the Wall Street Journal that was speaking about slowing rent growth in the US. And then I believe it also ran on CNBC. And so I'm sharing this slide because it reflects a conversation I had repeatedly last week. So when the Wall Street Journal is talking about slowing rent growth, they're still talking about rent growth that's positive. So, for example, in 2021, rents grew anywhere from 10 to 20%. In 2022, rent growth has been, to date, anywhere from 5 to 15%. To give you an idea of historical average, it's plus or minus 2.5 to 3%. That's what's normal rent growth in real estate. And so when the Wall Street Journal is talking about rent growth slowing, like going from 8% to 4%, that's still above historical rent growth. And more importantly, at Origin, we have our own machine learning and AI models that bring in roughly 3 billion pieces of data a month. and formulate an unbiased opinion of where it believes rent growth will be. And that's done not just city by city, but submarket by submarket, and actually address by address. We go all the way down to the building. So when you see on the left, Haven and Apache, Preserve and Star Ranch, these are actual addresses. These are the developments that we're looking at in Fund 4. These are for you and us, our investment partners. This is what we're investing in. And so when I see an article like that, they're so far behind what we have done this year. Our underwriting since January has predicted negative 10% rent growth at Haven and Apache, negative 8.3 at Haven and Cool Springs. And what's important about that is these deals still meet our cost of capital. So when you're worried about an article in Wall Street Journal that says rent growth might be 3% next year, at Haven and Apache, we're underwriting negative 10. It still meets our cost of capital. Now, when you look at 2024, and by the way, the CAGR is the compounded average rent growth over 5 years on the right. What we're looking at in our AI is a recession next year and a normalization of rents. So they've gone up too much over the last 2 years. They need to normalize. And then they retake off in 2024, and that's driven by the long-term secular demand for housing that is not being met. And so, at the end game is long-term secular trends trump business cycles. And if we believe, and our AI corroborates that that's a more powerful force. So I just want to address head on. We believe next year, and our AI corroborates, that rents are going to be negative, that we will probably be in a recession. That's what the yield curve is telling you when it's inverted. And then there's going to be strong rent growth emerging in 24 and thereafter. It also represents an amazing opportunity to be doing new deals, which we'll get to as well. Next slide, please. Here's your fund overview. This is my last slide, and then I'm going to turn it over to my partner, Michael. To date, we've raised 159 million, and we've called 104 million, so roughly 2/3, 65%. We have 8 investments. The average leverage ratio is 75%. And then on the right, you have the breakdown, and this is interesting because it slightly exceeds our goal in terms of co-GP versus LP. We wanted to have exposure to both. Of course, when we're a co-GP, you're getting the highest margin possible because we're co-developing the deal, and that was one of our goals. And in fact, going forward, you're just going to see more and more of that. And in addition, a lot more direct development. We have added significantly to our own investment management team, both development and construction experience. So we're set up pretty well there. And then we have 19% in net cash. The nice part now is, the risk-free rate's pretty high, so we can get 4% while we wait for our developments to materialize. And then below it, you have our geographic concentration, which again, as you see, is all of our target markets: Southeast Florida, Southwest Texas. Our goal is to have a diversified portfolio, but the net expected value of returns trumps creating a perfect geographic portfolio. We're more attracted to the higher margin deal, the better partner, the better land basis than anything else. So with that, Michael, I think I'm going to hand it over to you.
Great. Thanks, Dave. Can you see me? Because for some reason, my picture disappeared on my end.
Yeah. You're as good looking as ever.
Thank you. So I had dinner with a friend of mine last week. He's also an Origin investor, and he brought with him a printed copy of the Wall Street Journal article you see in front of you. And there is a massive disparity between public and private markets, and we see the disconnect too. We follow the public markets really closely, and the reality is that neither are right. Public markets, they're severely undervalued, and private markets have yet to reprice today. Camden Property Trust, this is a public REIT we follow very closely because the property set largely falls in line with where we invest. And it's trading at 2019 levels. And all you have to do is pick up your head, because we know for a fact that rents have grown in these markets by more than 30% since 2019. Values are up at least 50% on a gross basis. That's before leverage. And so, like, looking at this, you can't understand like how the public markets can be so off from a valuation. But the reality is that they just don't always do a good job of valuing real estate. And a public REIT is an entity with real estate underneath it, but the valuation isn't always the liquidation value of those assets in that portfolio. It trades on other fundamentals. But anyone here would love to go back in a time machine and buy properties at 2019 prices. Public markets, they get to an extreme on both sides. We see them, I think the Camden Property Trust right now, it's trading above a 6% cap rate. We've seen it also way below the private markets. It's just extremes on both ends of the markets. And it's not really indicative of where the private markets are today, but I would say that the public markets they're good leading indicators of general direction. And private markets, though, on the other hand, they're also not where they were in the first quarter of this year. Of course, they're lower. We see what's going on. Borrowing costs are up, they're around 5.5% today. Cap rates have spiked from 3.5% to 4.5% this year. And prices are probably down on a gross level between 8 and 15%, depending on what you paid for the property. That's gross. That's before leverage. There are two reasons, though, we have not seen a huge mark to market on the private side. And the first reason is just that private markets are slow to reprice. Transactions create price discovery, and those have come to a screeching halt. That is only going to change when loans come due, when banks force their hand, when people have to refinance, when these loans mature. You will start to see price discovery. The other reason is that revenue growth has offset some of this price decline. What David talked about, home affordability being at an all-time low right now or close to it, a lot of trapped renters are there, which is creating higher revenue and higher growth within multifamily properties. And if there were no revenue growth, this market would be down 30% on a gross level. And just as an example, so I can illustrate what I'm talking about, if you bought a $50 million property at a 3% cap rate, you would have an implied net operating income of around $1.5 million. If you increase the NOI by 50% up to 2.25, you have effectively grown into a 4.5% cap rate. That's what's happening here, is that you have the multiple, which is the PE ratio of earnings, has gone up substantially, but earnings have gone up as well, offsetting some of that advance in the PE ratio, or the cap rate as we call it. And short term, though, might be a different story. Long term looks good. Dave talked about the Origin Multilytics. Everything that we are looking at suggests that revenue growth is done for the next 12, maybe even 18 months. And some of these revenue gains are going to be given back that we've seen over the last kind of 12 months, 6 months, somewhere around that time period. Value add investors who acquired properties at peak prices the end of 2021 and 2022 are going to be hit the hardest. What does this mean for us, though? Let's jump into the presentation here, and I'm going to talk about valuations, because that's really what it comes down to. How does this impact our portfolio? Thank you, Jeff. We have what you see in front of you is the snapshot of the current portfolio. We have a total of 8 investments in this portfolio. All the way to the right is the expected value at stabilization. And to the left of that is the value we reported out last quarter. So we actually got some very good advice from investors saying, look, I'd like to see a quarter to quarter marking of what's happening with the value so we can understand the relative changes. So we appreciate that feedback. We have incorporated it into this presentation. And for anybody out there, if you have feedback on how we can make this presentation better, please email us. This is about you. This is for you. We want to get the data, the information that you're looking for in front of you. So values are up slightly, plus Sutton Place started going vertical last quarter. So that's been added here. And I'll tell you, when I first saw this information, my first response was, how can this be? Looking at where the market is, looking at where the stock market is, just this general malaise that's happening. And the main reason is that these developments that we've chosen are in some of the most undersupplied high growth markets in the country, and the fundamentals are strong. And rent growth continues to outpace even our own expectations. The other reason is really has to do idiosyncratically, and that's with our own underwriting practices. Underwritten rents and what we use for our initial valuations are rents that were approved at credit committee. And those rents, they have a built-in margin of safety. When our deal team presents a deal, what we're looking for is a deal that meets our cost of capital, but there's other ways to win. It's not priced to perfection. And the biggest way is that you have rents that are lower than forecasted rents. In other words, if the forecasted rents are $2,100 per unit in 4 years and the deal works at $1,900 per unit, it's presented at $1,900 rents. And that's just upside that we can capture along the way. This is the margin of safety that we're looking for before committing to any deal. And it's one of the reasons the reforecasted values continue to go up. Our rents started lower from the beginning, and the reforecast, the growth in these markets, it continues to outpace even our expectations. And I should note that these values, they're based on the extreme AI rent forecast. So we sort of manually adjusted even the AI model to say, look, set us up for an extreme recession. What does that look like in our markets? And I can tell you, not all markets are equal. Over the next year, 2 years, 3 years, some markets, not in our portfolio, have negative rent growth. But in all of our markets, we see positive rent growth over the next 3, 4, 5 years on average. And this forecast uses a 4.5% cap rate as well. That is kind of what we're viewing where the market should be priced today, given where the 10-year is, given where borrowing rates are today. And the last thing I'll say here is that most of these projects, they're going to be delivered in late 2025, and the environment should be more favorable than the one we're going to see in the next kind of 6, 12, 18 months. And lastly, the TBD you see here is Cool Springs. That project has been put on hold, and I'm going to cover why in a few slides. And the swaptions at the bottom, that is our hedge, and that shows you how much we paid, what it's valued at today. We paid $6.5 million, and it's worth close to $18 million today. And that alone has contributed around 10% of the fund's value of the capital that we've called to date. And that asset will help offset higher financing costs once these properties are stabilized and refinanced. And I should point out that this is a closed-ended fund. So anybody coming in is coming in at the value. There's a true up. We're still accepting investors in this fund for the next few months. You're buying into the portfolio at these prices, and you're also buying into the swaption as well. So if you wanted to increase your investment, it's not marked up. You're buying in at cost plus an equalization factor. So net, the fund right now of the assets that we have, it's expected to generate, I'll do the math, around a 1.9 multiple at stabilization. And the more I dig into the portfolio, the data, the information, talking to Mark, the more pleased I am with the portfolio. And certainly with my personal investment here, I've committed $5 million to this fund, and it's going to do well. We're all going to do well in this fund together. And the overall picture here is extremely positive. We've chosen the right markets and the right deals. Let's go to the deal pipeline next. As you can see on the left is the deal pipeline that we presented in the last webinar. We've killed a lot of deals in the past couple months. 6 months ago, the return on cost bogey was 5.3%, 5.4%. Today, it's trending closer to 6% to get a deal through credit committee. And there's just not a lot of deals out there that can pencil out in today's market. The good news is that we still have dry powder in this fund. We still are finding deals. There's value engineering opportunities for deals, for construction costs to come down, for the costs generally to come down in deals that will work, right? But we're looking for those highest margin deals in markets that are growing and the best locations. And that's really what it's about when we're assembling this fund and identifying the opportunities and approving deals, about putting those in. So we're excited about the market and the fact that the leverage has shifted a lot from land sellers to sponsors. Everything in the market is going in our favor from a capital perspective. The next slide, I told you I was going to talk about this. This is Haven at Cool Springs, and this is a really interesting case study, and one that we wanted to share with you here because we own the land here. We've owned it for quite a long time. This deal is 2 years in the making. And we got all the way to the point where we were ready for vertical construction, and we killed the deal. And so this project was delayed due to really things that were outside of our control. City permitting, we went back to the design stage. It went from wrap to podium, higher construction costs. The city wanted us to add things, and it just kind of kept creeping up. And then we get into an environment where you not only have higher construction costs, but also higher borrowing costs, higher cap rates, just very different than when we found this deal. We need the cost of this deal to come down by about $4 million for us to be interested in moving forward. And that means that even though we've committed to the deal and we're showing this as one in our pipeline and a piece of land we own, we're not putting another dollar into this until that dollar will meet our cost of capital in today's environment. This is an incredible location in Nashville, but basis is everything. We paid around $25,000 a unit for the land, and there's a huge edge, but it's not enough to offset the other variables in the equation. And we are starting to see sort of lower construction costs in all of our projects across the market because the interest rates are doing their job. And some of these construction costs is no longer about naming their price. The vendors out there, the developers and the subcontractors, they're actually much more competitive today than they were 6, 8, 12 months ago. So we're going to wait, and we're going to work with our development partner here to skinny down costs until the deal doesn't work. And if it doesn't happen, plan B is we sell the land. We don't want to do that. We love Nashville. We think the long-term prospects there are great, but it's a pretty good plan B if we have to. And there's profit in the land because you cannot buy land in the Nashville area for $25,000 per unit. And that's what I want people to understand, and why we wanted to really highlight this property is because at every point in time, we're reevaluating the deal, and we're not just going in with blinders on and saying, hey, we approve this deal, let's break ground. Now, we understand, once you do break ground, you have to finish the property, because one of the things we learned in 07, 08, 09, I mean, half-built properties are worth nothing. Where fully built properties, when you get to cash flow, you can get to the other side. And that's our goal, is evaluating, reevaluating, and putting our money in so that it has a very high risk-adjusted return and high probability of working. And that's our first job, is to protect capital, and that's what we're doing. Terra is the next deal that I just want to talk about really quickly before we go into the Q&A. This deal is located in Jacksonville, Florida. In Jacksonville, it's one of our favorite markets, and this city really has been flashing green lights in Origin Multilytics because of its potential for growth. And very few cities score the same way as Jacksonville does. And Jacksonville has affordability, it has lifestyle, it has no state taxes located in Florida, and that's what's really driving this growth. And so when we underwrote this deal, we underwrote it to a 5.7% return on cost, and very conservative underwriting. And we want to hold this up as a property, that we're looking for, that we like, that is going to do well and help us generate the returns in this particular fund. And we would love nothing but more of these. We can't fill the fund up with Jacksonville properties, but the markets we've chosen, the Colorado Springs, the Nashvilles, the Jacksonvilles of the world, these are the locations and the properties within those locations that are going to help us outperform and help this fund achieve its returns, even in the face of uncertainty in today's market. So thank you. Let's jump into Q&A now.
There is a question about the presentation being sent out, and of course it will be. We will send out the presentation to really all attendees and people that registered. So thank you for that. Other than that, I don't see live questions. Do you?
I don't. Let me go to the questions that were emailed in, Dave. Just give me a second. Jeff, can you send those to me just so I have them right now? Here they are. Got them. So Dave, I'll ask you this question and then you can answer it. Or I'll take control here because you don't have these in front of you. Are there rate caps on construction loans?
Not on construction loans. No, they're variable rate loans. But what we do, and Michael spoke to this, is we're executing swaps when we can, which then do lock in that rate. But you need to borrow money to execute the swap. So we create our own rate caps through swaps is the answer, but the loans themselves don't have them.
And Dave, I'm going to give this one to you as well. I mean, this is what we tried. This is from an anonymous. This is in the Q&A, and please, we've got quite a few people listening in. If you have other questions, this is the opportunity for Q&A. This person said, "I'm worried about investing in the fund before a big markdown, given the significant fall in values. What are the odds of a markdown in NAV in early 2023?"
Yeah, Michael went through this extensively with the slide. There's a very low probability of a markdown. It's never impossible. I mean, if the market corrected by 20% at the asset level, in addition to where it is now, so we've already incorporated the 5 to 10% correction at the asset level now, and it's actually very accretive to invest in this fund because you're investing $1 when it's probably worth $1.30, $1.40 the minute you get in. We haven't marked up the fund, but nothing, and I want to be clear on this, nothing is guaranteed in investing. The fund can go down in value. It's possible, but it would need another 20% at the asset level for that to happen because we're building to such high margins. I would also say that if that happens, you'll lose equal or more in the stock market, equal or more in the bond market. Like, keep in mind, our fund is up in value. Where are your other assets right now? How are they doing? We haven't done that comparison, but this is actually a place, if you're an investor, I'm a significant investor in this fund too. Michael spoke to that. I'm really glad I'm here and not somewhere else at that point. And if you're waiting, I don't believe you're going to get a better price to invest in that. Michael, we just had a flood of questions live, so let's move back to that.
Yeah, no, this one is live, Dave, and I'm going to just add to that because there's a couple of things that people should understand about this fund and just our valuation policy behind the way we value ground up developments. First of all, this is a closed-ended fund. It's not open-ended, and these developments are scheduled to be delivered in 2025. The first opportunity to exit this fund will be 4 years after the end of the final closing period. And when you think about ground up development, it's very different than stabilized. And what we're giving you here when we say mark to market, when we show the value at stabilization, that is not the mark to market of the fund. The way that we mark to market in ground up development is you take your cost basis and you look at what the expected value is in the future. And then you have a slope that goes to that value. And the mark to market in a closed-ended fund is only for information. You cannot get out at that price. You cannot get in that price once the fund is closed. In 4 years, you are going to make a decision whether or not you want to get out of the fund at that time or stay in. And when we're valuing, so if the terminal values of these properties go down from where we're forecasting them today, then the slope of that increase goes down too. And certainly what Dave said, if in the future, the terminal value, if you believe that the value when these things are done being constructed, that they're going to be less than the cost of today, then you absolutely shouldn't invest in this fund. But that's how it works in a closed-ended fund. And I wanted to make that distinction between an open-ended fund where people are getting in and out and mark to market. A closed-ended fund has its advantages because we decide when to sell the assets. And we firmly believe in the markets we're in and these values. And this isn't our opinion. This is done through Origin Multilytics, which crunches billions of pieces of data, and it has proven to be extremely accurate.
We had a question about exit cap rate assumptions in our methodology. And so this is our methodology. Going all the way back to 2021, when cap rates were 3.3 to 3.5 in these markets. In extreme situations like that, that's implying a 28 to 30 multiple. We just said we're not going to do that. We're not even going to pay attention. We were selling at that point for other funds, but we still wouldn't underwrite cap rates for Growth Fund 4 at those levels. We underwrote anywhere from 3.8 to 4.1, even though the market was much stronger. Today, the cap rates have gone back to plus or minus 4%, 4, 4.1, 4.2. Generally, we're starting all of our capitalization rates at a 4.2, 4.25. And then we also build in an additional 10% cushion. We each year we increase the cap rate 2%. So our exit cap rate and our base assumption models are somewhere around the 4.45 to 4.6 range, which is significantly higher than it is today, meaning there's conservatism built in there. We don't know where cap rates are going. I don't believe anyone on this webinar does. But I do know that we're building in conservatism. So if you're thinking about, where would you get nervous if you were in this fund, it would be if cap rates went up an additional 15%. Like that's where we're base case underwriting these deals. And then of course there's other variables that affect value. Rent growth would be the biggest.
Here's a question from Mark. How does the shrinking pipeline impact the velocity of capital calls going forward? It's likely to slow down, Mark, and that's a good question, because one of the ways that we've structured this fund is that investors do not pay us on committed capital. You're only paying us an asset management fee on the capital that you invested. So that is a risk we actually shifted to account for situations like this. If we don't invest the capital fast enough, or all the capital, then it's not a burden on you because you're not paying on that committed. And you should expect that the pace might slow down, but we still have a decent amount in our pipeline. And what I said earlier, I meant, which we're excited about this opportunity and things, the leverage disappearing from the people in the market who had it so much, from the land owners, right? Prices are coming down on that side. Construction costs are coming down. Even development fees are coming down as well. So the best guess is, though, that the pace is going to slow, but that there still will be capital calls. And we'll send out details about every capital call and the deals that we're calling capital for and why we think it makes sense in this environment. Thank you for your question.
We have a question from Yuri. Thanks for your question. Assuming that interest rates stay high, when we refinance construction loans, will we need additional equity at that time? Yuri, one thing to think about is the profit margin. So we're generating a lot of profits when we build a deal and execute it. We've done over $1 billion of development. Our average IRR is in the low 20s on these deals. And so, we try to over deliver in these cases. Here we're saying we're targeting a low return, but the reality is we've done better over a long period of time, many different cycles. When you're creating value, then it isn't that big of a risk that you can refi without more equity. You actually should be pulling equity out, not putting equity in. But the other thing to think about is what Michael touched on, which is our interest rate hedging strategies. So if rates were to go high and it would require equity to be in because the debt service levels are low based on the higher interest rates, that means our hedges are also up significantly. They're up 11.3 million just for this fund alone to date. And so those profits, both cash and unrealized profits on swaps and swaptions, would then come in to help finance that additional equity. That's why you do hedge interest rates. But thanks for your question.
Yeah, and the one thing I'll add there too is there's a huge advantage of investing through a fund versus an individual deal, because there is a chance that when we go to refinance, or anybody in this market, that the proceeds don't retire all of our equity. In a fund, though, the advantage we have, and we're going to have to sell assets in year 4 anyway to satisfy investor redemptions. Well, that becomes equity for the fund that allows us to do that. If this were a single deal, there were 2 options. Either A, we can go out to an alternative lender and we can get a bunch of preferred equity at a high rate to bridge that gap, or we can call money from investors at that time or something. But that's not how it is. And there's a huge advantage of investing through a fund and having the ability to sell assets to satisfy debt from other properties. Can you tell us your economic best, worst, and 50th percentile case scenarios for real estate in general, as well as growth fund 4? There are always outliers that we can't predict today, and Origin Multilytics is something that takes into account the world as it exists. It doesn't look for outliers or black swans or something happening. And we know that there's a lot of geopolitical risks in the world right now. And those are the X factors out there that we can't measure. What Origin Multilytics looks at is affordability. It looks at rent growth. It looks at population growth, job growth, all kinds of data, but it doesn't look across the sea and know when there's going to be a black swan event. So there's always the propensity and the chance to be very wrong here. And when you're talking about a 50th percentile scenario here or outliers, there's outliers on both sides, upside and downside here. Can I put a number on that? Not really. We always reserve the right to be wrong, and we will continue to update people every other month on these webinars and do a reforecast and reevaluate where rents are in the market, where the world is trending. But there's risk in trying to generate 14, 15, 16% net returns to investors. We like to believe that we mitigate a lot of that risk through our processes and our strategy and investing in an asset class that is really need-based, multifamily. It's generated some of the best risk-adjusted returns for the last 20 or 30 years. So I don't know if that answers your question directly, or Dave, if you have anything to add there. Goes my camera. But that's kind of how we view the world.
We have a question from Michael about cap rates going up, what would happen, and also an interrelated question that's anonymous about public REITs versus private cap rates and the disparity. So I'll try to tackle both. So in terms of the public REITs, remember that public REITs are less than 7% of the total private real estate market, if you will. So it's this tiny subset of this massive market, but it is what we see every day in the stock market. So you can follow it more closely. The other thing is public REITs really they move with the stock market and they move with sentiment in a way that privates don't. That's why we have always recommended you should have both in your portfolio. If you want more stability, it's certainly the privates that you want. They tend to have higher dividends and less volatility, but there are moments in time that you probably should be buying publics. Michael touched on that when he was talking about Camden. To give you an idea, last year when we weren't valuing anything at a 3.5 cap, public REITs were implied cap rates in the low 3s. And now, that they're implied cap rates in the 5s, they're just incredibly volatile. In the private sector, the cap rates have gone up, but they never were quite as low. We certainly weren't valuing anything that in that level. But let's get to the real question, which is, how can this fund, because this is what I believe the real question is, how can this fund lose money? At what rates and cap rates does that happen? And there's 2 things that I'd like to point out. One, cap rates are only one part of the equation. There's really 3 that matter a lot. One is the construction costs, one is the cap rate, that's your multiple on earnings, and the other are rents. We believe that the construction costs have stopped going up and will start coming down. That's very good for this fund because our underwriting is assumed in construction costs going up. pretty dramatically. And so if they're not going up or if they're going down, we're going to really improve our basis relative to our underwriting. And the other is rents. And so I talked about this before. We believe rents are going to be flat and negative next year, but then positive in year 24, 25, 26, as the long-term fundamentals take over the recession element, and to some extent, regression to the mean of really strong rent growth thus far. And so I can't answer your question about cap rates in relation to valuation without looking at the other two. But broadly, think about it this way. If we held rents fixed to our underwriting and construction fixed to our underwriting, but only moved cap rates and moved them against us, the first 15% we've already underwritten for, right? We 10%, I should say. We have a 10% cushion. And then if it goes past that, now you're talking about the profit margin. You know, we build to a 30 to 40% profit margin at this point. And so if cap rates then keep going up, you're not losing money, but you're making less. And then what I would point out is, unless you're making the choice just not to invest, you just want to stay in cash, where's the stock market when all this is happening? Where's the bond market when all this is happening? If you want to be in investments, I still believe that you need to invest for the long term, especially in an inflationary environment. And these are the types of investments that give you the best opportunity to protect and grow money. And that's why we formed Origin. So that hasn't changed. I still like this investment more than virtually anything else I see.
Next question. There's really two that are combined here, and they're about the mechanics of the fund, getting in and getting out. And investors who get into the fund today are buying in at basis. There's no markup, there's no markdown, there's nothing. There is, though, something called an equalization factor, because investors who have been in since the beginning have already invested in these projects and they earn a preferred return and they've been paying fees on that invested capital. And those two things have to be made up by investors who are getting in today. So as if everybody came in on day one. You don't get a free look 6, 7, 8, 9 months into the fund. You have to pay that preferred return to current investors. That's not revenue to us. That's revenue or an income item to the investors who are already in the fund. The second question was about getting out. The fund will end 4 years. The first end will be 4 years from 3/31, so right around 2027. That's right. And at that time, investors have to make the decision whether they want in or whether they want out of the fund. And the mark to market will be done at that point in time where we value all of the assets, and you have the right to get out of some, all, or none of your investment at prevailing rates. Whoever gets out, though, at that time, it doesn't impact those who stay in. So if the fund is, worth X, right, we'll just call it $300 million at that time, and you decide to punch out and we have to sell assets, it doesn't make the value of, and we're buying out investors at that time, the investors who stay in will still enjoy the appreciation going forward and the cash flow, et cetera. And one of the reasons why we designed the fund like this was for tax efficiency, because in private real estate, the idea, in order to get wealthy and take advantage of the benefits of owning private real estate, it's cash flow and appreciation. And we just don't believe that the buy, fix, sell model is right for this investment class. There's incredibly favorable IRS rules where you should be staying in to get the depreciation, get the cash flow, everything else. And most funds, and we're guilty of this too, our previous funds were all buy, fix, sell. But at some point, David and I said, why are we getting out of these deals? Why don't we just stay in? Why don't we give investors the opportunity to build more wealth? And so this fund has optionality in 4 years. There's nothing magical about it, but it really is, as we model it, it's at the intersection of where your IRR has peaked and your multiple is still strong. But as you hold a portfolio longer and longer, your multiple is going to continue to go up, which is the wealth effect, but your IRR is going to go down. And then you can get out any year thereafter just by giving us notice. So you can get out in year 5, 6, 7, and 8. So a lot of thought went into that particular component, all within the context of building wealth, saving taxes, and just enjoying the long-term benefits of being in real estate. And the beginning, the first 4 years, is to build that cushion of equity against loss. So thank you for your question.
Yuri, thanks for your question. He asked a question about how much of investable assets should be invested in Fund 4. That's not a question that we can answer. We're not investment advisors. I do think you should think about your own liquidity, your own income, your own spending habits, your own risk parameters for, how much returns you want and how much risk you're willing to take to obtain those returns. These are all things to think about. Thanks for the question. And then the last one, it's anonymous. And by the way, yes, we're always speaking to Fund 4 when we say the word fund. That was another question. What happens if you're trying to exit properties to redeem investors, but the market isn't strong? Michael, you want to address that? I think there were 2 questions around that same thing.
Yeah, I mean, I kind of did just address that. So it doesn't impact current investors. If the market isn't strong and the market is low, then we will be selling assets at the then prevailing net asset value of the fund. But for those who are staying in, it just means that you have 1 less asset or 2 less assets in the portfolio. And we'll decide at that time which assets we're going to sell to redeem investors. But you're going to own more of a smaller pool of assets at whatever the mark to market is at that time. And that will continue to grow into the future. And you can stay in or get out. And as I said before, every year we're going to have redemption rights. So I hope that answers your question. I tried to answer it before. And if you still have confusion, please just email me at michael@origininvestments.com and I'll get you a detailed answer.
So those are all the questions. I agree. You can email me as well, david@origininvestments.com. We really do enjoy speaking to our investment partners and learning about you and your goals, as well as answering your questions. So please give us a shout, call us, or email us. These are interesting times. I can't tell you enough, huge opportunities in these times. People focus oftentimes on challenges, and there are challenges, but there's also opportunities within those challenges. And I think that these will augment what we are trying to do into the future. You've hired us to be risk managers. You've hired our team, our experience. This will be no different. You're going to do very well in this fund. And importantly, on a relative basis, you're going to do much, much better than you would in anywhere else in real estate. Michael and I are very, very confident in that. And so we work really hard every day to deliver the returns and protect your capital. Michael spoke to deals we've worked on for 2 years and put on hold. This is serious stuff. We are both self-made. We both really worked hard to get to where we are. And I know, Michael, maybe you can send us off with the famous slogan that we live by every day. You know it. We don't want to be the people that used to have money.
Oh, yeah. Dave coined this term many years ago. I never want to say the words, I used to be rich. And that's what we live by in this fund and the risk management. And a lot of the stuff you may not even know as an investor about the decisions we make behind the scenes. And it's so often the time, or those decisions that you don't see that matter the most, or maybe you don't understand. And I say that because I've learned this the hard way through investing, through with others in 05, 06, well before Origin. In the time, it was awful. I felt dumb. I didn't know it, this and that, but it led me to find Dave, for us to create Origin, because there's a lot of hidden risks out there. And I think Warren Buffett says it, best about when the tide goes out, you understand, who's not wearing shorts or something to that effect. And that's going to happen even in this market, as we see. And so I hope we painted a realistic picture for you about what's going to happen, but also why we believe we're still optimistic about this fund, because there could be some short-term pains. But everything for us has been about protecting basis. And we've embarked on this. We've been pounding the table Don't buy value add. Don't buy 3.5 cap rates. Stabilize assets above replacement costs. And we think you're going to be really happy. And I'm really happy that I'm in this fund. And it's a pleasure to be presenting here today and talking about this. And what you can expect is that we will continue to update you on this fund, changes in the market. And if you ever have any questions, just email us. That's all. And if you're interested in this fund, you can email us. Email investorrelations@origininvestments.com. That's all. So thank you for attending today.
Yeah, thanks very much. Bye-bye.